Hi, Bill Bodner here, Mortgage Market Guide. Thanks for tuning in to our MMG weekly recap. So up on the screen on a Thursday, another sea green. Mortgage-backed securities having a wonderful day and really overall a week. And what we're seeing with the 10-year note yield pulling back from 175, good time. So we had the Fed minutes this week, and the Fed minutes essentially more of the same. There was a little fear going into this statement. Again, it's a review of what the Fed members were saying at the last meeting in March, and you always want to dig into the details. What were the folks in the room thinking about? And so there was concern that the Fed may allude that they're going to hike rates maybe sooner rather than previously thought. They gave some up. You had the review like updated forecasts. They also, there was worry that there would be tapering of bond purchases. Also, inflation, maybe there would be fear that inflation is becoming a bigger problem. And what the minutes revealed is that this is more of the same. Inflation is going to be transitory. We're going to have higher inflation over the next couple of months, probably going to be nicely north of 3% in a couple of months. But after that, we'll taper off. And that's something that we believe here at Mortgage Market Guide. But inflation is not a problem, and they're not even thinking about hiking rates or tapering their bond purchases. So that gave the reason for bonds to improve because of the inflation fears, but also stocks to improve. But the one thing that we're watching that could certainly have an effect is the tone is changing from the administration's policy, and they have this infrastructure, this American jobs plan that they're putting together, and it's called infrastructure. Where whether you love it or hate it, a lot of it is not infrastructure, but more importantly, it's how they're paying for it. Supposedly, that has the markets on edge, at least stocks. And that's this higher tax notion. And frankly, I think the markets are going to be worried more about higher taxes than they are about higher inflation. And so that's a theme that we're going to be watching here over the next couple of weeks, and you should as well. But one thing for sure, the bond market moving lower in yield, beneath 175 now, is a good sign, but it may be because not only is inflation not going to be a problem, but that higher taxes are coming. And higher tax is not an economic policy that drives growth. It slows things down, and it would be good for bonds. So I hope this finds you well. These are things that we're thinking about heading in the next week. And by the way, we have an inflation number next week. We do have CPI coming out. And again, inflation is going to be higher on a year-over-year basis because of the higher energy prices on a year-to-year basis. And so it's probably going to be close to 2.5% next month, and maybe probably north of 3% when we get to the April number in May. And then once we get to June, it'll be, maybe even higher still. And so we're probably going to see consumer inflation as high as mortgage rates in the coming months. But then we do expect things to kind of level off, especially with, so many folks still on the sidelines, as evidenced by the jobs report, right? We still have the lowest labor force participation rate in nearly 50 years. So those are some of the things we're thinking about. Hope this finds you well. Be safe and have a great weekend. Bye for now.